Hey, greetings, everyone. Coach Cam here. Just wanted to come and do a quick video on this one big, beautiful bill act, right? So if you've been watching the news or on the internet, I'm sure you've heard someone speaking about it. You know, some people are excited about all the deductions, and some people are upset because of the potential negative ramifications of this act. So I just want to touch bases on these quick 12 deductions real quick, and then wrap this video up. I don't want it to be too long, but I think it'll be good uh, for y'all to understand these 12 deductions and then know how to move forward or how to apply them for the average everyday citizen. So the new law brings major tax cuts and new deductions that benefit both everyday taxpayers and business owners. Here's what you need to know. But before I go into that, as you can see, it's a simplified breakdown for tax pros. I originally put this together because I was going to share this information with only the tax professionals that work here to work with me here at Prosperity Tax Solutions. But then I decided just to make this available for everyone. So that's why that's there. So let's start with number one, lower tax rates. So this has been made permanent. Tax rates that were cut in 2017 are permanent now. They went from 39.6% down to 37. That 25% tax bracket went down to 22%, and that 15% tax bracket went down to 12. So that has been made permanent. It's been locked in for good. That's a good thing. All right, number two, standard deduction. So standard deduction increased and made permanent. See, 90% of people, of tax filers, use the standard deduction. So it's important to kind of understand that. So let's talk a little bit about those numbers. If you're filing single, the standard deduction has been made permanent. The 13,850, it was 6,350 and scheduled to go back at the end of the year, but that's been locked in, and I'm excited about that. So married filing jointly 27,700, head of household 20,800, married filing separately 13,850, and surviving spouse 27,700. So again, those have been made permanent. And just a quick example for those who really don't understand the standard deduction and how that works. So let's say if you were a single filer and made $40,000 in 2024. So the $40,000 income minus the standard deduction, which is 13,850 for a single filer, that's going to reduce your taxable income down to 26,150, meaning you're just paying taxes on the 26,150 instead of the full 40,000. Obviously, it would be better to pay taxes on less than it would more. So the standard deduction is a good thing. Number three, cap on SALT deductions was increased. So the SALT is an acronym that stands for state and local taxes. It was originally 10,000. It's been increased to 40,000. That's phenomenal, especially in states like New York, California, and New Jersey, where they pay significantly higher taxes. So now they get to write off 40,000 instead of just 10,000. So what are state and local taxes? That's stuff like your state income taxes, your local income taxes, your property taxes, your state sales taxes. And this is useful to be able to write this off, especially in places like Florida and Texas, where they don't necessarily have a state income tax. They can still write off the sales tax. And the way you do this is you just keep up with it. Now, you just keep up with it. You can calculate it based off of your receipts. Now, there is a formula or calculator that you can use to do this, that you can utilize, or you can just do it the old-fashioned way. Keep your receipts and keep track of all this. And this can be very useful, especially if you have like big purchases, like you bought a car or something like that. This could sometimes be better than writing off your state income taxes. Like you can't do both, right? So in a place where you was going to do your state income taxes, if you was writing that off, then you couldn't write off sales taxes. You can't do both, but You can do the math and see which one is more beneficial to you. And again, in states that don't have a state income tax, they definitely could use the sales tax. So number 4, car loan interest deduction. You can deduct up to 10,000 in car loan interest if you buy a new American-made vehicle and you fall within the certain income limits, right? So if you're single, the income phase out begin at 125,000. Married filing jointly, income phase out begins at 250,000. So that's a great deduction if you qualify for it. Now, I'm gonna try to go through these pretty fast. I'm not gonna read every word on the screen, but again, the beauty of the pause button, right? So if you see something you want to read it all, definitely hit pause and go ahead and review that information. But I'm gonna try to get through this as quickly as possible. Number 5, child tax credit. It has increased by $200 to $2,200. Now, don't confuse the child tax credit with the earned income credit. The child tax credit is for children under the age of 17 or so, 16 or younger on December 31st. Credit begins to phase out once you get to a certain income. So single or head of household, it begins to phase out once you get to 200,000, and it'll phase out by $50 for every 1,000 above that income threshold. So that's great to pick up an extra $2,200 per child that's under the age of 17. Number 6, bigger deductions for seniors. So we talked about the standard deduction already, but if you're a senior, that's someone 65 and older, you get to pick up an extra $6,000. So for example, if a single senior, typically 13,850, but because you're a senior, you add that 6,000. Now you got a $19,850 write-off. And if you married filing jointly, if it's two of you, 6,000 each, that's an additional $12,000 on top of the 27,700. So you're talking about 39,700. So that's a great benefit for seniors. All right, let's look at number 7, no tax on overtime deduction. So you get to write off up to 12,500 if you are single, and 25,000 for married filers. So how does this work? Let's say you're single and you earn 65,000 in regular wages and another 15,000 in overtime wages. So you already get the standard deduction. So you're going to get to deduct that 13,850, but now you get to deduct another 12,500 overtime deduction. So that brings that income, that taxable income, down from 80,000 to 53,650. So this overtime deduction is going to be great for people who qualify for this. Now, I suggest you keep up with this. If you work a lot of overtime, keep up with your overtime so that you can make sure at the end of the year that it's reflected correctly on either your last pay stub or your W-2 or whatever. Keep up with it yourself so you can make sure you're getting your deductions. Now, here's what I suspect a lot of people think this means. You think that when you work overtime, that that high tax rate that you typically see on your pay stub will be gone, and now you're not going to get taxed on your overtime. That's not how this works. You're still going to see the taxes come out on your check when you work the overtime. You got to write that off at the end of the year. So that's not something that you're going to see in your paycheck like immediately, right? You're gonna have to write that off at the end of the year. So I'm pretty sure there's some people out there thinking, well, I'm gonna work a lot of overtime. We ain't get taxed on overtime. It don't work like that. All right, you still gonna get taxed. It's a deduction that you can write off when you file your taxes. Number 8, no tax on tips deduction. So qualified taxpayer can deduct up to 25,000 in tip income from their taxable income. Income limits apply. So if you're single, it begins to phase out at 150,000. Married filing jointly, it begins to phase out at 300,000. Now you still will owe Social Security and Medicare, taxes on this income, right? So some of the jobs that may qualify for something like this is like waiters or servers or bartenders or hairdressers or barbers, massage therapists, ride share or delivery drivers, nail techs, estheticians, etc. Right? So you will be able to go ahead and apply this deduction if you're in a field that earns tips on a regular basis. Number 9 is the QBI, Qualified Business Income Deduction. Let me move this over. It's blocking my view. All right, so the qualified business interest income deduction is now permanent. So this is a 20% deduction. So the QBI deduction lets you deduct up to 20% of your qualified business income. So who qualifies? To qualify, you must have income from a pass-through entity. That's like a sole proprietor, and they're using a Schedule C or the LLC. It could be single or multi-member, S corporation, partnership. These are pass-through entities. So if you had like a C corp, right, this wouldn't apply. All right, you wouldn't qualify for it if you had like a C corp. So it has to be a pass-through entity. The deductions start phasing out if your taxable income, not just business income, your taxable income exceeds 191,950. So if you got some W-2 income and some business income, they both combined, you know, cannot be more than the 191,950. Well, if it is, it starts to phase out. So um, that's how that works. And remember, it's got to be a pass-through entity, not a C corp. I kind of say this is sort of like the standard deduction almost, but for a business entity. But this is a great deduction if you qualify for it. Number 10, 100% bonus depreciation is back. A lot of people are super excited about this, right? Business owners can now deduct 100% of big purchases like vehicles, equipment, furniture, even like a yacht or a private jet, right? Um, applies to purchases made after January 19th, 2025. So bonus depreciation allows business owners to immediately deduct 100% of the cost of qualifying business properties in the year it's placed in service. Instead of spreading the cost over several years, this is faster depreciation, a huge tax write-off now, not later. And some examples of qualifying property like business vehicles over 6,000 pounds, GVWR, office furniture, computers and equipment. And let me back up to that GVWR. That's 6,000 pounds gross vehicle weight rating. This means that it's a misconception. You always hear people say, well, you buy you a vehicle over 6,000 pounds and you can write that off. Well, the vehicle don't have to weigh over 6,000 pounds. It's the gross vehicle weight rating. This means the maximum gross weight that a vehicle is rated to safely carry, right? That's your 6,000 pounds. It's got to be over the 6,000 pounds GVWR. That means your vehicle, the fuel, the accessories, the luggage, the passengers, everything combined, that vehicle can safely move, the 6,000 pounds or over 6,000 pounds. As long as that, and that's not the actual weight of the vehicle. So that's a big misconception. So just to give you an example how that worked, and I harp on this a little bit because you always hear people say that 6,000 pounds, get a vehicle over 6,000 pounds. Like, yeah, you're not getting a vehicle over 6,000 pounds. It's the GVWR. So you finance a $6,000 work truck in October of 2025. So check this out. That's October, like a couple months and the year's over, right? So you buying this vehicle near the end of the year, and start using it for business immediately, right? Even with no money down, you can still deduct the full 60,000 on your 2025 tax return. So even if you financed it, you're not paying for this stuff cash. Even if you're financing, you can write off the whole amount. Obviously, it's got to be for business purposes. And I put that Grant Cardone used this because uh, there's a video out there where he talks about how he bought a private jet. I think it was like I think he paid like 50 million. Don't quote me on that, but something crazy, 50 million or something. And he was able to write off that. He was talking to his CPA, and he owed like a astronomical amount of taxes, and it was the end of the year. It was in December, and he was asking the accountant or the CPA, "What can I do to prevent paying this?" And the CPA was pretty much saying nothing. You know what I'm saying? Like the year's over, it's you got to pay the money. And he was just like, "No, it's got to be something I can do." Well, anyway, I'll put the video in the description. Go back and check that out. Listen to him talk about that. I found it very interesting how he was able to use this 100% bonus depreciation to write off a $50 million private jet that he used for business, and that's very important, right? So enough about that. Number 11, 100% R&D write-off. So this is research and development. So business can now write off all research and development expenses. So I mean, if you're in that type of business, like a tech startup, or software developers, product manufacturers, people who do a lot of research and development, then this is going to be a phenomenal. I mean, you can write off 100% of all the expenses used for research and development. That's going to be a pretty big deal if you qualify for that write-off. And finally, number 12, opportunity zone tax breaks. I'm not going to go real deep into that other than to say, this is probably more of a long-term wealth building strategy. You can read the example there of how this works. Now there are some short-term benefits. Obviously the bonus depreciation, what we just talked about, cost segregation, and some more things uh, that you can get benefits from, like right away. But for the most part, I think this is a long-term wealth building strategy here. So you can read that or look more into that. So that's all 12 points that I wanted to touch bases on. Now, all of this sounds great, right? Like these are deductions. These are that people can benefit from, not just business owners, but there's some deductions there that's going to benefit average everyday people. So why do you see people on both sides of the fence? Some people are saying this is great. Some people are saying this is going to be bad. It's going to hurt the economy long term. Why the debate? Why the debate? So let's talk about that a little bit, because there are some potential downsides of this bill. And one of the downsides that they're saying is it's projected to reduce government tax revenue by over $2 trillion over the next decade. So that's $2 trillion back into our pockets, or back into the taxpayers' pockets, because they're saving that money. They're not having to pay it out in taxes. So that's a good thing, but that's reducing the revenue that the government has coming in by that same $2 trillion. And that's going to have a negative effect potentially, right? Because now they may have to cut some of the social programs, stuff like Medicaid and SNAP or food stamps and stuff like that may be affected by this loss in $2 trillion worth of revenue over the next decade. Now they got to replace that. So are they going to increase taxes? I mean, what are they going to do to replace that? So that's the big debate. It talks about the wealth gap expansion, benefits skewed towards high income and business owners. So some of these benefits are permanent for business owners, and some of the benefits that affect average everyday people, that's still not permanent. And at some point in the future, that'll go away or they'll be reduced. So they're saying, yeah, this is a temporary fix for the average everyday person, but the business people get permanent fixes or permanent solutions, right? So then they talk about how this could be a strain on the state when it comes to like Medicaid and stuff like that, because now the state get a dollar for dollar match. It's almost like they got an unlimited tap or unlimited resource of money coming in to fund Medicaid programs and stuff like that. But be it could be a block grant going forward. If Medicaid becomes a block grant, states may struggle to fill the gaps. And what does block grants mean? They'll get a block of money. It won't be unlimited. It won't be as much money as they've been getting or been receiving from the federal government. They're just going to get a block of money, and when it runs out, it runs out. So if it runs out before the end of the year, the state is just pretty much shit out of luck, right? They got to figure it out. So that's kind of where the debate is, because that's going to force states to either um, try to restrict or make it harder for people to qualify for these benefits, right? So if they know we only got enough money for a certain amount of people, or a certain number of people, I should say, we're going to try to reduce it or restrict it or make it harder for people to qualify because we don't have enough money for everyone anymore. And then if less people are qualifying for Medicaid, then less people are going to some of these hospitals in rural areas. So they're losing money. They could potentially cause hospitals and stuff to shut down because they're not getting enough people with Medicaid coming through anymore. So I mean, it could have a negative effect. It really could, long term. But right now, what we should be doing is shifting the way we think. Right? We can't be sitting around complaining about what the government is or isn't doing, complaining about the economy. I always say, let's work on fixing your economy, your own personal economy. Because see, in bad economies, there's still people that are thriving, even in bad economies. And in good economies, there's still people that are poor and barely getting by. And it's a great economy. So it doesn't matter if you spend all your time focused on the economy. Let's spend our time focused on our personal economy. Let's stop being consumers. Let's start being creators. Let's start thinking about how can we create some additional income for ourselves? How can we create jobs in our community? How can we do things to help instead of waiting on the government? All right, leverage the same tax code that the wealthy use. All right, they say this stuff benefit business owners. Well, that's a clue. Become a business owner. Now I know not everybody will be able to do that, but everybody that can should be, right? Number three, financial literacy is non-negotiable. My parents didn't really teach me anything about finances or building wealth. We were financially illiterate. And that's okay. They didn't teach me, but I'm an adult now. So if I stay that way, that's on me, right? That's my problem. So let's not stay that way. Let's start digging. Let's start learning. Let's start figuring out some of these strategies. Let's start figuring out how we can own our own businesses and take advantage of these things that the other people are taking advantage of. Start where you are. You ain't got to try to run out here and buy a 20-unit apartment complex, right? Let's start with a Roth IRA, right? Let's start with a life insurance policy that builds cash value, like infinite banking or something like that. I mean, let's figure out the little things that we can be doing that's going to have a major impact long term on our finances. Let's get in rooms where wealth is being talked about and discussed. You don't have to physically go anywhere. You can find a lot of these chat rooms and different groups and organizations right online. Just get involved. You can just go seek the information, right? Don't wait on the politicians. Take control. No one is coming to save us. No one is coming to save you. No one. So you got to save yourself, right? These politicians are going to save themselves, right? Save yourself. You don't have to be rich to build wealth, but you do have to be intentional, informed, and consistent. Even if you start with zero, Your mindset, activity, and education can take you from where you are to where you want to be. So let's get out here and start changing the way we think. Let's unplug from this negative news and let's start teaming up and figuring out what we need to do to improve our own personal economies. How can we help each other? And we don't have to worry about stuff like Medicaid. If you don't have to depend on Medicaid, you don't have to worry about Medicaid, right? So, hey, that's all I got to say. I'm going to go ahead and wrap this up because I will go off on a tangent and a little rant, but hopefully that was helpful. And I'll see you all on the next video. I look forward to seeing each one of you at the top because the bottom is way too crowded. Peace.